This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now, plenty to talk about in Wednesday's trade action. We got news from OPEC. We saw the dollar go back higher. We found a little support for a while, at least in wheat and corn, before we kind of backed off at the close, but a lot to really take in. Joining us today, Mike Zuzolo, Global Commodity Analytics. Mike, good to catch up with you again, sir, and a busy week once again, no doubt. Plenty of stuff going on in this trade right now, Mike.
Yeah, and I feel like this week, especially, Jesse, we're burning a lot of rubber, spinning our tires a lot, but we're really not going anywhere. And I think that's indicative of the trade really trying to get underneath and get their arms around some of these really big, major fundamentals. And I think today, for instance, between the WTO coming out and essentially slashing world trade volume for 2023, going from almost 3.5% in their prior forecast about 3 months ago, down to 1%. So I would call that zero, essentially. But between that and then this major shift in terms of our relationship, our geopolitical, our strategic relationship with OPEC in the Middle East and OPEC Plus, including Russia, with them countering and going directly against our wishes of not cutting supplies, and not only that, but cutting supplies double what we had thought initially. I really think we're in a pause right now in the trade, trying to understand exactly what is going on here.
Yeah, there's a lot to take in here, and let's start with the OPEC thoughts. I know you had a blog out last night talking about the OPEC potential cuts that did come to fruition, 2 million barrels a day, and the wheat market. But just walk me through some of your thoughts here, and I'll pull up on the video feed as well, the monthly crude chart, just for some perspective here to start. But Mike, what are you seeing with this OPEC cut and how it's tying into everything?
You and I have talked about the New East and the New West before. That's my new analysis for this year of trying to figure out why we're splitting up in kind of a geographic and emerging market pattern. In other words, the BRIC countries, Brazil, Russia, India, China, now Saudi Arabia, Iraq, and the UAE, all working against the United States and Japan and Europe. And those three being the New West. This OPEC decision to cut 2 million barrels a day, Jesse, adds to the validity of that analysis that there is a distinct difference between these two groups of countries, and they revolve around how fast a pace the New West is trying to curb fossil fuel consumption and go towards more climate-friendly consumption of energy. And these countries not only produce a lot of fossil fuels, but they consume a lot. And if they didn't consume a lot, then their economies, or I should say, if they didn't consume as much because prices were too high, their economies would fall dramatically compared to us in Europe and Japan. And so I really think that's where the battle lines are drawn. So that gets you to the idea of why did we see a 2 million barrel a day cut by OPEC Plus? Well, the first easiest reason is because the United States and Europe, led by our Treasury Department, want to put a price cap on Russian oil, but yet they want the Russian oil to continue to flow. And that's just not going to work. That's just not going to be something feasible in OPEC's mind, because you're essentially trying to limit the price of oil and still get the same volume out of OPEC Plus, meaning Russia. The deeper issue, I think, is, and this is what I'm doing to do more analysis on, is that I have a suspicion, a research analytical mindset that I want to try and support and validate, that the OPEC Plus countries want us to remain in a high inflation environment here in the United States and Europe. and really kind of strangle our supplies of energies, keep inflation high, because then that keeps our monetary policy on a very strong raising of rates and very contractionary when it comes to our economies. And so I think what they're trying to do at this point, and the White House said today that OPEC and Saudi Arabia are no longer really working with us, that they have taken the Russian side at this point. So I can say this with a little bit more validity than I said last night. I really think that if somebody's going to have an economic problem and a recession, the OPEC plus nations and this new East group of countries want the Western countries to feel it the most.
Well, that's a very interesting thought, Mike. And we think about not only crude, but then you throw in the ag commodities, corn, beans, and wheat specifically. And I'd love just to hear your thoughts on this. I was reading through your blog and I wondered, could wheat, which traditionally kind of follows the dollar up and down, could wheat team up with crude oil possibly here to go up and down? Because we saw on Wednesday, wheat ignored the dollar moving higher and for a while had some strength. So I'd love your thoughts on that thought, Mike.
Yeah, and this is not a 1 week or 2 week type of analysis that we're talking about, Jesse. And I appreciate you pointing, that type of mindset out, because that's exactly what I'm trying to get at. Is that much like most of 2021 and early 2022, almost all the heavy lifting of the broad-based commodity rally was done by the crude oil, the vegetable oil, and the wheat markets. And so I could see, because of the continued supply and weather problems, along with OPEC, again, cutting supply. This is still that cost push, supply side inflation that we continue to contend with. And that's what really brings us our rallies. And I think that's going to continue. I could see where, much like what we saw in the first of 2022 up until May, we do see the wheat and the crude oil come back together. And that's obviously predicated on the idea that we don't see a sharp rally in the dollar. And, this is where what we're looking at right now is the Deutsche Bank Agriculture Commodity Index. And what you see is the major low in 2020, thanks to the Federal Reserve saying they want inflation. Then they came in May, June and said, we don't want inflation. And they really hammered that home in August. And we lost the channel, that uptrending channel. But if you take a look at that chart in the bigger picture and go all the way back to that 2008 high that we were at in this specific commodity index, we have a long way to go to get back to the 2010, 2011, 2012 levels, let alone 2008 before the financial crisis. And so this chart is kind of signaling that it no longer wants to be in an uptrend, but wants to go sideways until it gets more information. That's kind of how I read it. So what I'll be looking for is, can the crude oil then go back up above $90 a barrel, head towards 100 plus a barrel, and that all of a sudden gives this channel renewed life. And all of a sudden we're back in terms of a supply-led market that takes the broad-based commodities higher.
Mike, as well, I've noticed this week that, KC wheat, Minneapolis wheat have had their days to move higher, but Chicago wheat, SRW, has found a little pressure here and there. What are your thoughts just with wheat as a whole, as well, with planting going on across winter wheat country, although it's still very dry? I know that's one of the concerns. A lot of growers kind of dusting in that wheat. We talked about that last week. But as you look at how the three classes have worked together this week, what are your thoughts there a little bit?
Yeah, that's a really interesting point you bring up, because you're right. The soft red wheat, I think, has more of the dollar feel to it right now. It doesn't have the weather supply side support that the hard red does. But you think about what USDA did last week, and since we talked, Jesse, with them taking the major production levels down, not just hard red but also soft red wheat, I think the soft red would be a willing participant in the upside with hard red leading, if we could calm that dollar down. And I think this goes back to, in this chart, we're looking at that purple line in this weekly SRW chart is that 52-week moving average. And then those two circles in this chart are, again, when the Fed decided to go from a very tight monetary policy to a very loose one and allow inflation in July, August of 2020. And then they reverse thrusters in a big way in that Jan, Feb, March time period and really hammered it home to us in August that they weren't going to let up. So I think what we're trying to do is rebuild the SRW, but we've got the dollar in our way. I am still of the view that if we really want a trend change, and this goes back to your earlier question and point, if we really want a trend change and we want the whole complex of commodities to go up, we really need the wheat and the crude oil and maybe even the vegetable oil market to once again lead.
Well, Mike Zuzolo, Global Commodity Analytics, is our guest here today. Mike, let's talk a little bit more corn, soybeans from Wednesday's trade action. Corn seemed to follow wheat. It was kind of just trading a few pennies either side of unchanged all day. Beans had a little more pressure, though. Any thoughts with quarter beans after Wednesday's action?
Yeah, the soybeans morning because a couple indicators that I was looking at were suggesting that maybe we've got some sideways to higher trade. And being in November options, I don't want a sideways market because I lose premium. One of those indicators was the currency markets and specifically the Chinese currency and the Brazilian currency. And both of those strengthened dramatically on Monday's trade as it ended up being. And I think that's where the trade is right now, Jesse. We've got harvest pressure. We've got terrible river levels. We've got a really tough export market staring us in the face if we don't get a weather pattern change. And so I think that the fundamentals of the funds are really based upon the currency markets. Now, one other thing that maybe is going to be useful in probably a week or 2 weeks, maybe sooner, is the fact that the Russian pig prices in several key areas are now back at their highest level since mid 2021. So they're really up there. And that's really nice to know because not only that, but the Dalian futures for soy meal in China is at about $610 a ton. That's the highest since 2012 for their meal futures market in China. You put those two things together, and all of a sudden you maybe have a meal basing pattern in the not too distant future. And that would be really supportive historically. I really like meal markets that are leading the bull charge because that's your feed side.
Mike, you mentioned the low river levels, and I'm glad you brought that up. I want to turn our attention maybe to some basis ideas a little bit here because we've been hearing basis at certain locations, big drops. I've heard some big drops at Illinois on the river, et cetera, et cetera. What are you seeing when it comes to basis, corn, beans, and how that ties in with this low Mississippi River level situation? Is there a correlation there?
Yeah, for sure. I think, that's one of the things about doing the puts in the grains, Jesse, is I've got clients in Nebraska. A client in central Nebraska called me today and he said, look, I am getting a $1.20 to a $1.40 out of the field positive basis right now. And they're trucking it all the way from central Nebraska down to Garden City, Kansas for the feedlots. Should I buy puts or should I sell cash? And I said, that's to me, if there is a no-brainer, and there's never a no-brainer, but if there would be one, that is, yeah, sell it, let it go. Don't pay the storage, especially if you don't have on-farm storage. But that was an easy call. About 2 hours later, I talked to an Owensboro client, and he said, my basis is really fallen out of bed. Have you seen that? And I said, no, I haven't. And so after he got done talking to me, I pulled up some of the basis charts that I'm able to get through my software, and I decided to put this chart into our talk today. And the green line is the Owensboro spot basis. It's gone essentially from zero, a flat basis with Chicago futures, to a negative $1.10 in just a little over a week. And so that client was right on the money. And he said, not only that, but he said, if I wanted to put beans in an Owensboro elevator on the river, it's 75 cents to put it in. And so what I have here in the chart is the green line is the Owensboro cash basis, while the purple line is the Chicago corn in the futures market. You see the corn's been sideways for pretty much the better part of a month, and is curling up a little bit even, but that doesn't matter. The base is still just tanked. So that is a clear, I think, footprint and fingerprint of what's happening with what's going on with these low river levels. And it sounds like it's going to get worse. Some of the key areas like Memphis, I'm hearing next week they may challenge their 1988 all-time low for Mississippi River level. St. Louis is in a world of hurt. I'm hearing Cairo's got barges stuck. I heard, I don't know if this is true or not, but I heard earlier today that down in Louisiana, there was a point where over 1,000 barges were trying to get through one point. So I think this is a major factor in terms of the headwinds that we have and why the market's probably not ready to jump in with both feet because of some of the supply tailwinds, the weather tailwinds that you and I have been talking about.
Mike, let's turn our attention to livestock here as well. You brought up that client trucking corn down to Garden City, Kansas to feedlot country. We've talked about that before. How are we going to get feed into feedlot country? Looking at feeder cattle, a decent day on Wednesday. Actually, I was pretty happy with how things looked there after kind of a choppy week. Talk to me about what you're seeing in feeder cattle and the cattle complex as a whole right now.
Yeah, I'm getting more neutral. I mean, the break in prices between the soybeans, the fat cattle, the hogs, the feeder cattle, I feel like the month of September did a lot of good for bringing back demand and taking the price down to find demand again. There is a gap in January feeders around 172.50, Jesse, that I'm really watching. So that's a couple $3 below the current market. Feeders are still, highly correlated negatively with the corn market. That's probably why we saw the bounce on Wednesday. But I would also say that I'm getting a lot of reports in the central part of the country, Nebraska, Kansas, especially, of a lot of calf sales, cash calves going into the warehouse, going into the sale barns, and not getting nearly the price they were getting just a month or 3 weeks ago. So it suggests to me that we've got a bubble of supply in feeders on the cash side, but I think we're also basing in this market, and that's where this monthly feeder cattle chart comes into play. Now, this is only November feeders. This does not have it doesn't have January in it, doesn't have September or August feeders in it. It's only got the November contract in it, and that's what I like doing with some of these specialty charts that I have access to. We're up against a support line on a channel. We're trying to hold last month's lows and also try and hold that line. If we would take that support line in white out and break through the bottom of the channel, then I think my undervalue level that's still about $10 lower may be something we'd be in the line of sights for, and especially if that was matched up with the corn rally. Now, at that point, I think as you get into the November time period, if we would see that, I would probably start being a buyer, or a re-ownership strategy would be designed in the January, because I think there's going to be a hole in feeders as we get past the Christmas holiday.
Mike, just pulled up to look at the cash markets as well. Feedlot trade's been slow to start this week. A little activity coming in Wednesday afternoon, but not a whole lot. And it feels like it's pretty steady with what we've been seeing right now.
Yeah, I think it'll be stronger than we've seen in the last couple weeks, or hold its strength. The 144 to 146, I think we'll get a lot of business done. What there is out there, because the ground beef prices are falling pretty dramatically. The 80% number is down at a level that would suggest to me that it's going to get a retail bid here, and the consumer is going to go after more ground beef in the month of November, especially. So I think again, the cattle market as a whole, I think, is pretty balanced at this point, Jesse, unless something new would come out to feed the bear. For me, the feeders would be the logical thing. When it comes to the corn market. For the fat cattle, it would be me being wrong about the hogs finding a base here.
Well, and I'm glad you brought up the hogs. I don't want to forget our good friend pork. Fingers are crossed over here. Have we found some support in this hog market? It's taken a beating, a really strong day on Wednesday, but we saw a decent day a few sessions back, and then we fell further. So my thought is, have we found some support? What do you think?
I think we have, between the avian flu really starting to make more headlines in Europe, and I'm pretty confident it's going to make headlines over here, and also the fact that we do have that cash market, that cash index well above where the October hogs are. I do think we've made a basing pattern here, and we have some upside, especially given what I talked about about the Chinese prices. They're still tight on supplies, and that's usually pretty good for our export market, and usually means less about a strong dollar. So I do think this $90 level should catch a lot of support.
Well, Mike, I hear the phone ringing in the background. I know you are a busy guy here today. Before we run out of time and let you go, any other final thoughts for us?
No, I think that the what you do every week is so valuable, Jesse. And I just hope people, I know it's a busy time of year and I know there's a lot going on. And, we haven't even touched the nuclear situation, but a lot of things happening. And that makes me generally go after paper positions until I can figure out more about what to do, especially when you have a bad basis if you're near a river and can't get the exports out. So please consider working with me or getting a subscription, because what Jesse and I talk about every week, I think, can help a lot. But you do such a nice job and a great service to the people, the ag community out there by what you do, and I appreciate it.
Well, I appreciate your analysis and your time as always. Globalcomresearch.com. That's where you can learn more. Sign up for a free trial with Mike. And Mike, appreciate it as always, sir. Enjoy the rest of your week. We'll talk to you next week.
Thanks, Jesse. You too, sir.
Mike Zuzolo, Global Commodity Analytics, joining us here today on Market Talk. That's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.